Welcome to this episode of Biz Now. I'm your host, Matthew Carr. Demand for gold is skyrocketing. With the stock market in chaos, investors are hoarding the safe haven. But not even gold is safe from COVID-19. The global pandemic has exposed some glitches in the precious metals infrastructure. Some of these offer opportunities. Others are a kind of a warning sign for investors. To talk about both of these aspects, I'm joined today by GoldMining Inc.'s founder and chairman, Amir Adnani. Thanks for joining me, Amir.
Hey, thanks for having me, Matt. Good to connect with you.
Now, Bloomberg recently reported the gold market in New York is facing a massive squeeze because of the pandemic, disrupting the entire supply chain for deliveries, just as investors are making a run towards precious metals. For our viewers, can you explain kind of like what these disruptions are and what do investors need to know about them?
Matt, there really has been a historic squeeze in the gold market recently when some short sellers appeared to exit and investors rolled forward their contracts. The bullion market was also thrown into turmoil as logistical disruptions caused by the coronavirus pandemic led to a divergence of prices in the US and London. A lot of the physical supply of gold travels with regular commercial flights. And so you can see with so many flights grounded, this was really an unexpected event. So an issue ultimately is whether there would be enough gold in New York to deliver against future contracts traded on the COMEX. So the open interest in April contract dropped almost 30% last Wednesday, indicating a small amount of short covering. And as investors rolled positions forward, this is ultimately what everyone's trying to play here in terms of reconciling the physical disruption that we're having. So ultimately, adding to the squeeze is the large spot market in London. It's dominated by 400-ounce bars of gold. And only 100 ounce and kilobars are deliverable on the COMEX contract. So late on Tuesday is last week, after New York futures shot to the highest premium to the spot price in 4 decades, CME Group said it would launch a new futures contract under which 400,000 ounce bars would also be deliverable. So the long and short of it is that we just simply have never seen something like this before, Matt. There's never been something like this where you see from the mines that have been disrupted. There are over 130 precious metal mines globally that have been impacted by the virus and have announced some type of suspension, to refineries that have been shut down. 3 out of the 4 refineries in Switzerland that are on the border, in the part of Switzerland near the border with Italy. Those 3 combined represent 30% of refining capacity. Those have been shut down. And then all the flights that have been grounded. You look at the entire supply chain of gold, from mining gold all the way to refining and getting gold to the physical markets in London and New York. This is an unprecedented supply disruption like never seen before, not even when you compare it to times of war.
Yeah, so that's what I was saying. Like, I was just sitting there thinking, I was like, I don't think we saw anything like this during the financial recession. We haven't seen this during any of the natural disasters. This pandemic has literally shut down the entire kind of infrastructure for gold and mines and refiners, like you said.
Well, it's funny. We keep talking about the war comparison. Just the other day, I read in a very good publication the comparison about how much was spent adjusted for inflation during World War II by all countries. And that number was over $6 trillion. And already the stimulus that has been spent fighting this virus is over $6 trillion. So you put that in perspective, and it's absolutely it's just breathtaking. I mean, beyond anything else. But it really goes to show you why now more than ever, with this debasement of fiat currencies going on due to all the stimulus that is being injected, gold and physical concept of gold as a store of value, it's never made more sense to me than it does now.
Yeah, that's what I was going to say. I was going to say, like, with all of this sort of stimulus and the relief packages, as we're going to call it, flooding into the system, that's got to bring down the price of all of the currencies, and that would inflate the price of gold. Is that correct?
Yeah. So ultimately, when we think about this whole thing, we got to think about the fact that gold is, and this is Goldman Sachs did really well the other week. It's the haven of last resort, and we ultimately have to consider the fact that it's no one else's liability. It can't just be reproduced and printed. You can't print gold. You have to mine it. And that's why it is the ultimate store of value. So when we think about the fact that the printing press and what that the Fed has, and the amount of quantitative easy to infinity that has been introduced, no longer even a cap on it.
Yeah.
They want to print their way out of this thing, to infinity and beyond. That is going to be a debasement of fiat currency, Matt, that we have never seen in our lifetime. This already dwarfs what happened during the 2008 financial crisis. And so what we also saw during the 2008 crisis was that you had that initial shock, that initial liquidity crunch where everyone's selling everything to raise dollars. Mm-hmm. But ultimately, one of the biggest beneficiaries of what happened in 2008 and all the stimulus that was injected ultimately was the gold price. And we ended up having in 2009, 10, and 11 a multi-year rally and bull market in the yellow metal. But already the amount of stimulus not being introduced this time around to fight the virus exceeds the levels that we saw in 2008. And we're not even done yet. Already President Trump and the administration is talking about the next stimulus package that's going to be introduced. Another $2 trillion he tweeted today, right, on infrastructure and energy. And it's global. It could be Japan, it could be Europe, it could be China. It's truly going to be the most unprecedented event of our lifetime to see these countries print money to try to basically work our way out of the slump that has been caused by the virus.
Now, with everything that you just said, does that change your outlook for gold? Like recently I've talked to, people in the industry, and some of them see, an unabated run to $2,500 an ounce. With this squeeze in place and with all of this money flooding into this debasement of currencies, what kind of price do you think people could actually expect for gold? Because I know right after 2008, 2009, that's when we hit those highs of $1,900 an ounce.
We need to look at a couple of some variables here. Okay, so number one, we have never had that. There's a lot of kind of for the first time events going on here. Just in the month of March, in the month of March, we witnessed a lot of financial history. Mm-hmm. Some of the aspects that really impact the price of gold are the fact that for the first time in the U.S., we're seeing negative interest rates. This has been fairly common in Japan and Germany, but we're seeing interest rates in the U.S. now. This was for the first time in March. We've seen the size of the Fed balance sheet grow just in 1 week by over $500 billion to over $5 trillion. So the size of a record high. And again, and ultimately, we have to look at the relationship between the gold price and negative real interest rates. And negative interest rates were with us before coronavirus. Before coronavirus happened, Matt, we had over $10 trillion of debt worldwide that was yielding negative rate, which is basically economic insanity when you consider what negative interest rates mean. Lending money so you can get back less in the future. This makes no sense. But ultimately, with the amount of historical stimulus, fiscal and monetary stimulus that's going to be introduced, the size and the pool of global negative yielding rates is not only going to increase, but we're going to see downward move in negative real rates. And that has the correlation to the gold price. So if we look at it in that sense, gold should not only reach its previous historic high of $1,900, but it should most likely surpass that. And when you look at TD Securities, you look at Bank of America, you look at Goldman Sachs, you look at Citi, all these banks have come out. You look at UBS, who's come out. They're calling for $1,800 to $2,000 gold in the next 12 months. Certainly, the environment and the backdrop is there to support that kind of move. And again, it's not even, I think, regaining the historic high. It's a question of how much higher than the historic $1,900 an ounce high can gold appreciate.
Now, we saw shares of gold miners as well as the price of gold itself dip briefly along with the broader market. Do you have an opinion on why that happened? Did that make sense to you? Is that a move that you look at now and go, okay, I understand why everything, all asset classes fell at once?
I think in an ideal sense, I would say I wish that the gold didn't behave the way they did in the sell-off, because when we had the sell-off in the month of March, where it was frustrating, frankly, okay, to see gold stocks and the gold price sell off with everything else, because you figure, hey, this is supposed to be our insurance in our portfolio. I don't want to see that happen. So to one regards, I was frustrated to see that. However, we saw the exact same thing in 2008. When you get these sell everything events, which aren't, this doesn't happen all the time. This is quite rare. When you get those sell everything event where the system has to deleverage because there was so much leverage in the system and everyone gets margin calls at the same time. And there's this rush to sell anything you can to raise cash. And gold stocks are performing well leading into this sell everything event that took place in March. They became a casualty along with everything else. That was frustrating. Having said that, when we go through the phase here, where, again, you think about how much longer is it going to take before we get normal economic activity? How much longer is it going to take to get back to where things were? This is where, when we're not facing those margin calls all the time, which seems to be behind us for the time being, this is now the true environment where gold can really shine. Because despite the fact that, again, it was sold down with everything else when the system had to deleverage, now, as is quite clear to all of us, this idea to stay home is going to take longer. This idea for the economy to recover to where it was is going to take longer. Governments are going to have to stimulate like never before. The printing press at the Fed and central banks has to stay open extra time. This is now where I think we see what we hope would happen to have, the reason you have gold in your portfolio is to get that ultimate protection and outperformance when everything else is challenged. And now I think we're coming out of that environment in the month of March, and we should see better performance for gold and gold stocks, Matt, in the months to come.
Well, obviously it seems like gold is poised for another major move, especially as the global pandemic continues to trigger volatility in stocks. I want to thank my guest today, founder and chairman of GoldMining Inc., Amir Adnani. Thanks for joining me, Amir.
Thank you, Matt. Good to connect with you today.
And from everyone here at BizNow, thank you for watching. I'm your host, Matthew Carr. Until next time, here's to high returns.